please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. You're watching Taking Stock. It was a truncated week that we are taking stock of, but next week is a full week, of course, and we'll have important triggers. The market, first up, of course, will react to developments from the Jackson Hole Symposium as well. Joining us now is Pramod Gubi, Head of Equities at Ambit Capital. Pramod, thanks for joining us. Always good to talk to you. So, you know, what's been interesting is that all through this week, and in fact, over the last couple of weeks, we have seen the same trend continue, that the domestic money is intact and maybe even, you know, pouring in more at lower levels, but FIIs continue to sell this market. Since you talk to a lot of FIIs, what's happening? Is this emerging market phenomena or is it just India-specific issue?
I think it's a mix of both. There is an emerging market phenomenon that's happening as we head closer to the central bank meetings towards the end of the summer, because that's clearly one of the risks on the anvil. But also we've had some geopolitical issues over the last few weeks or so, which have also caused some sort of a flight back to safety. I think that's the trend which is continuing. In India, I guess it got accentuated with all the issues around Infosys and so on. So I would think it is a mix of both, you know, just highlighting the risk-averse situation.
Pramod, when we spoke to you early on in the month, you were sounding fairly cautious and you were calling for maybe some sort of a correction. So the question is, have we seen most of it in this 3.5–4%, or is there more downside?
Yeah, absolutely. I mean, the caution, we have been cautious for a fairly good time now, and I mean, that's largely based on fundamentals rather than flow. We've been highlighting that the domestic flows have remained solid and continue to remain solid. But however, from the fundamental perspective, I think both the economic recovery and the earnings recovery have been less than what the market rally seemed to suggest. Now, the question is, you know, this 3 to 4% sort of correction, does that now make it more you know, reasonably valued, commensurate to the earnings and the economic recovery? Well, we don't think so. We think there's some more upside, some more downside left before you know, you build some sort of margin of safety to valuations, and then you can you know, clearly say the stocks are attractively valued and see buying coming back again. So we would continue to maintain our cautious stance with a downside risk.
Pramod, the big talking point of the week, Infosys. Do you think if Nandan Nilekani does come back and in an executive capacity, that would soothe the nerves? And could that mean that the worst could be over for the stock? Or is this a stock where institutions would want to sell now on rallies?
Yeah, I think the latter is more likely because, yes, somebody like Mr. Nilekani coming in would definitely be put some bottom to the stock from a short-term perspective. But the bigger question is what happens to the business in general. Remember, this has been one of the toughest times for the industry in general, where there's been dramatic shifts in the way IT services have been bought by global CIOs. Industry as a whole, not just Infosys, has been grappling with this challenge, and there have been some you know, strides made towards adapting to those changes, and this has required significant changes in management and people to adapt to those changes. But amidst all this, if you find a company going through you know, such massive disruptions, getting it back on the rails to adapt to the changes in the industry will make it that much more harder. So while it might be a temporary relief as far as the stock is concerned, in terms of the business, we'll have to wait and see, you know, what sort of changes are brought in, who's going to be at the helm, what's the long-term strategy. There was a long-term strategy put in by the erstwhile CEO. Does that continue, or is there a course correction? All this will mean that you know, there's more and more uncertainty on the business. So until we get clarity on that, you know, this is something that one should be cautious about.
Pramod, this week's buying was concentrated on select NBFC stocks like Bajaj Finance, L&T Finance, and also pharma. It seems people have been looking for bargains, and some of these stocks are a good 10–15% off their 52-week close. Do you see merit in either of these two pockets, richly valued NBFCs or, pharma stocks which have been beaten down?
Certainly not the richly valued NBFCs. I think, while some of these companies are pretty solid companies run by good quality management teams, we reckon, it's a bit overdone in terms of valuations. The long-term earnings growth simply do not justify, or at least doesn't leave much margin of safety on the table to be buying at these levels. We would rather wait for a correction to have a look at them. Pharma, on the other hand, it's a slightly more nuanced situation there. I don't think you can paint the sector as a whole with the same brush. There are different companies with slightly different prospects, and as a result, you could see merit in looking at some of those companies which have been beaten down yet have relatively stronger long-term prospects. At the same time, some of those which continue to remain weak fundamentally could become value traps. So it's a slightly different story on both sides.
What is market's key expectation from the Jackson Hole Symposium, Pramod, and could it have triggers for the markets to move, and or do you think the overriding factor would still be what's happening with Donald Trump and the kind of statements that he's making?
Yes, I mean, in the shorter term, yes, it will be what the US president and the events around him in terms of risks to the market. But the Jackson Hole Summit will be crucial in terms of assessing when do we get to the stage when the central banks actually unwind, because there have been conflicting data points coming through, both in terms of growth and inflation. While growth numbers are holding up fairly nicely, calling for a beginning of the unwind of sorts, you still aren't compelled to do that because inflation hasn't reared its head yet. So, however, amongst all the central banks globally, I think the Fed seems to be slightly closer to that unwind. The question is, how soon will that be? Will that be this September? And so any sort of commentary from the Fed governor will be crucial to be watched out at Jackson Hole. But mind you, the other central banks also who are seeing recoveries in their economies. Europe is nicely bouncing back, while it may not be as strong as the US is in terms of relative proximity to that unwind situation. We are progressing in that direction. So we can envisage a situation in the next 12 to 18 months where perhaps the Fed, ECB, the BOJ and BOE could all act in concert, perhaps in a phased manner, just to get a sense of what the market reaction is. But that's clearly the biggest risk for asset markets globally in the next 12 to 18 months.
So since you do have a cautious view because of local and global factors, Pramod, at the index level, how much of a fall do you think we perhaps could see? And also, what pockets of the market are most vulnerable?
Well, I mean, it's always a tough thing in terms of second-guessing where the markets are headed in the short term. So all we can do is at what levels do the earnings justify sort of a margin of safety for the markets to bottom out and recommend investors to get in. Markets tend to move on either side of that equilibrium, so it's bound to undershoot if we see that correction, and I'm sure that's a great opportunity for buyers. But in terms of pockets of the market, I would reckon some of the richly valued financials it could be in for harder fall than the rest of the market. Whereas some of those which have already been taken down, like the ITs and pharmas, may hold relatively stable.
Okay, Pramod, thanks a lot for your time today, and have a good weekend. That's the view from Ambit, slightly cautious on the market. But as we wrap the show, let's listen into some market opinion that we got all through this week.
I'm neutral India, although with an overall bullish context on emerging markets. And then we're underweight IT, we're underweight healthcare, and we're also underweight consumer staples as they're expensive. Within a global benchmark, we're neutral discretionary, neutral materials, and we do have an overweight at this point in financials. India is an expensive market with earnings downgrades.
General thesis is that while there is a fair amount of pushback that investors give in terms of valuations in India, we think you're in a sweet spot in the cycle where valuations will actually tend to be fairly high over the next 3 to 5 years, as a lot of fundamental transitions that we think are materially positive start playing through. And some of the cyclical elements, which is earnings, asset quality, capex, each of these has tended to be a little bit of a disappointment. We actually think that these are all kind of lining up together, so they might not come in the next quarter or two, but over the next 6 to 18 months, I think you could see a lot of these actually come back. So I think that mix of fundamental transitions and cyclicals kind of lining up will keep multiples high.
Quarter, we have seen around 3% knock on our Nifty EPS for full year FY18, and now we're expecting around 14% kind of a growth. We need to cognize to the fact that second half of FY18 will have a very low base to contend with, given that we had demonetization related issues in the FY17 second half. So to that extent, there will be some optical jump to the earnings, but the real fact is the underlying operating environment, when you look at the earnings beyond the headline numbers, that is not showing any improvement. Whether you look at the bank asset quality, whether you look at the broader consumption environment, or even the CapEx sectors, that is not showing any meaningful pickup as yet.
I think for the last couple of years, we've been very positive on the space. I think we've been telling investors that with the subsidy burden gone, the under-recovery is gone, these companies have comparative advantages which are almost unbeatable. They have installed networks, they have almost quasi-monopoly status, and we still believe there's substantial upside in the OMC space, leaving aside company-specific events around takeovers and so on. We think the oil marketing company story is poorly understood and underappreciated.